Mortgage ballers slash shot callers. I'm Tim Ray. I'm one of the hosts here along with Rich Hanlon, my partner. Today we're going to talk about something that just happened to me as a loan officer. I frequently get calls from clients that I'm working with, clients that I've worked with in the past, because I love that. I love when clients reach out and they just want to talk about their payment or rates or the market, you name it. I love that relationship. I love that part about my job. But one thing I don't love is sad conversations with clients about money. And given the state of the current economy, with inflation at an all-time high, the last 2 years have devastated a lot of people. When you get a call from a client like I just did, telling you that they just received a letter that their payment is going up $300 a month, it's devastating. The question is, what happened? It was a fixed rate mortgage, and suddenly now they are being told by the mortgage servicer that the payment is going up $350, I think, a month. That's terrible, but it happens, and it can happen, and it can happen to you. And it's important to understand how your mortgage payment works. In this video, we're gonna break down how the mortgage payment works, how that payment can change, and what you can do to prepare for it. Stick around, we got a good one.
Let's dive into why mortgage payments can fluctuate and what components contribute to these changes. When you purchase a home, your lender will typically show you what your monthly payment will be. Many people assume this amount will remain the same for the entire duration of their loan. However, that's not entirely true. Your mortgage payment is made up of several components, some of which can change over time. These components include the principal, interest, property taxes, homeowners insurance, mortgage insurance, and possibly homeowners association fees. The principal is the portion of your payment that goes toward paying down the loan amount. For example, if you have a $300,000 loan, your principal payments reduce this balance over time. Interest is the cost of borrowing that money, and it's calculated as a percentage of your outstanding loan balance. If you have a 7% interest rate on a $300,000 loan, you're paying 7% per year on the remaining balance. Property taxes are charged by your county, not your lender. These taxes are based on the assessed value of your home and can vary significantly from one county to another. Homeowners insurance is another essential component. While your lender requires it, the insurance itself is not provided by them. It covers potential damage to your home from events like natural disasters or fires. Mortgage insurance, on the other hand, is required if your down payment is less than 20% or if you have an FHA loan. This insurance protects the lender in case you default on the loan. Lastly, if your home is part of a homeowners association, HOA, you'll need to pay HOA fees, which can vary widely. To make managing large payments easier, lenders often use escrow accounts for property taxes and homeowners insurance. Instead of paying these large bills annually or semi-annually, you contribute a monthly amount into the escrow account. This account acts like a savings account managed by your lender. When your property tax or insurance bills are due, the lender pays them from this account on your behalf. This system ensures you don't have to come up with a large sum of money all at once. While having a fixed-rate mortgage means your principal and interest payments remain the same, property taxes and homeowners insurance are likely to increase over time. As your home's value increases, so do your property taxes. Similarly, the cost of replacing your home rises, which can lead to higher insurance premiums. Mortgage insurance, however, typically decreases over time as you pay down your loan. HOA fees can also change, although they are less predictable. Several factors contribute to the increase in mortgage payments over time. Property taxes are one of the main culprits. They are based on the assessed value of your home, which is determined by your county. This assessed value is usually lower than your home's market value, which is beneficial because it keeps your property taxes lower. However, as your home appreciates, the assessed value increases, leading to higher property taxes. Another reason for the increase is that initial estimates for property taxes and insurance can be incorrect. This is especially common with new construction or when there have been significant tax reductions for the previous owner. For new homes, lenders often have to estimate property taxes since there is no tax history. If these estimates are too low, you might face an escrow shortage when the actual tax bill comes due. This shortage means you haven't set aside enough money in your escrow account, resulting in a higher monthly payment to make up for the deficit. Homeowners insurance can also drive up your mortgage payment. As your home increases in value, the cost to replace it also rises, which can lead to higher insurance premiums. Additionally, changes in the insurance market can affect your premiums. For instance, in places like Florida, homeowners insurance has seen significant increases due to factors like hurricanes and the departure of insurance companies from the market. HOA fees can also change, although this is less common. The cost of maintaining common areas and amenities in your community can fluctuate, impacting your monthly HOA dues. Understanding why your mortgage payment increases is the first step in managing it. If you find yourself facing higher payments due to property taxes, you can challenge the assessed value of your home. This process varies by county, but it generally involves submitting a request to have your home's value reassessed. Keep in mind that success is not guaranteed, but it's worth exploring if you believe your home has been overvalued. When it comes to homeowners insurance, shopping around for the best rates annually can help keep your premiums in check. Many people forget about their insurance once it's set up through their lender's escrow account. However, it's crucial to review your policy each year and compare it with other providers to ensure you're getting the best deal. If you're part of an HOA, stay informed about how your fees are being used and participate in community meetings. This involvement can give you a better understanding of potential fee increases and how to prepare for them. For those dealing with an escrow shortage due to underestimated taxes or insurance, communicating with your loan officer or title agent can provide clarity. They can help you understand where the estimates came from and whether there were any special circumstances, like tax reductions for the previous owner, that could have affected your payments. While a fixed-rate mortgage offers the stability of consistent principal and interest payments, it's not the only option available. An adjustable-rate mortgage, ARM, can have a lower initial interest rate, but the rate can change periodically based on market conditions. For example, a 7/1 ARM has a fixed rate for the first 7 years, after which it adjusts annually. These adjustments can lead to increases or decreases in your monthly payment, depending on the market. It's essential to understand the terms of an ARM, including the caps on how much the interest rate can change each year and over the life of the loan. While ARMs can be beneficial in certain situations, they come with the risk of higher payments if interest rates rise. Some might wonder if renting is a better option to avoid the fluctuations associated with mortgage payments. However, renting is not immune to increases either. Landlords face the same rising costs for property taxes, insurance, and maintenance, and they often pass these costs on to tenants through higher rents. Additionally, renting doesn't offer the same benefits as owning a home, such as building equity and potential tax deductions. While homeownership comes with its challenges, it also provides long-term financial benefits. The key is to be prepared for potential increases in your mortgage payment and to take proactive steps to manage them. Understanding why your mortgage payment can increase over time is crucial for financial planning. By breaking down the components of your mortgage payment and recognizing the factors that can change, you can better anticipate and manage these fluctuations. Property taxes, homeowners insurance, and HOA fees are all variables that can lead to higher payments.
Number one, taxes. Now, you know your taxes are probably going to go up. Taxes typically do go up. So when you close on your mortgage and you're looking at that payment and that payment looks perfect, just know that your taxes are going to possibly go up. So be prepared for that. Knowledge is key. Number two, know the difference between an adjustable rate mortgage and a fixed rate mortgage. They kind of explain that in the video, and you should know this, but you'll be surprised how many people actually close on loans without understanding the real difference. An adjustable rate mortgage is going to change. It's important for you to know when those changes are going to take place. Talk to your loan officer about that and make sure that your loan is either a fixed rate mortgage or an ARM. And if it's an ARM, know everything about it. All right, number 3, and this one is my favorite, don't max out your pre-qualification. So when you first meet with your loan officer and he or she does their evaluation and their application and analysis, and they tell you, hey, congratulations, you qualify up to a mortgage of, let's say, $4,000 a month. That's great. That doesn't mean that you have to use all of that $4,000. Maybe don't use that. Maybe try to get your payment a little lower in knowing that the payments probably or could go up with the insurance or the tax changes that happen over the life of the loan. Finally, and probably the most important one here, is work with a lender and a realtor who understand your budget and are going to help you stay within that confines of your budget. Choose a team that truly and genuinely is not trying to push you to the next level up on that purchase price. All right, well, that's it for this episode of Mortgage Ballers. Thank you for your time. Please like, subscribe, and share this video with everybody you can so that we can help people not get shocked with the dreaded payment increase letter that comes in the mail so often. Have a wonderful, wonderful day. And what do we say here at Mortgage Ballers? Stay thirsty, my friends.